Okay, we're going to get started. We have finally made it out of 2021 and now into 2022. When it comes to tax planning, many of us do what I call rear view mirror planning. And actually, tax planning needs to be done, it needs to be looked at into the future. So I want to take a few moments today to review 5 year-end tax planning strategies. Now, these strategies can be done anytime during the year. Maybe there's some things that you haven't thought about. So we're also going to talk about a few of the changes in the rules from the Biden tax law. Strategy number one is gifting. Around Christmas and the end of the year, we start thinking about gifting during the holiday season. And strategy number one is gifting appreciated stock. If you've got an appreciated stock, or if you gift it to a charity, for example, the capital gain will be erased. The charity will get the stock at the value of when it's sold. So if you bought the stock at 100 and you gifted the stock to the charity and they sold it at 200, then naturally they get the $200 price. However, if you gift a stock to an individual, you have to understand that the stepped up basis will follow them, and so will the capital gains. So when they liquidate the stock, they will have to pay the capital gain tax. Benefits are assuming that you itemize, you receive a charitable donation or deduction from the value of the stock. You also avoid the capital gain tax on the growth of the stock. And all of this that we're looking at today, please make sure that you run this by your tax advisor, CPAs, or anybody that helps you with taxation, your personal advisor. Qualified charitable distributions. This is an option for individuals to take a distribution from their retirement account. This distribution goes directly to the qualified charitable organization of their choosing. Typically, we see this is when people start taking required minimum distributions out of their retirement accounts. Let's say that there's a $10,000 required minimum distribution. Well, that's going to increase your taxes, right? Maybe you don't need the money. So if you're already going to be taxed, how can you get around it? Well, the qualified charitable donation will help you do that. If you've got a $20,000 distribution that's due and you only need $10,000 of it, you can send directly from your IRA to your charitable organization the $10,000 tax-free. It will be a deduction for you, and it will also satisfy your RMD. Strategy number two, Roth conversions. The sunset laws in our current tax environment are going to come to an end in 2026. We're now entering 2022. So now you have 4 to 5 years to actually get this done in our current tax environment. We are probably looking at the lowest taxes that we have seen for a while going forward. You hear stuff about all the money that we owe and all the debt that's being created. It's already been spoken about that taxes will have to go up. So now's the time to have a really good conversation with your advisor and your tax advisor on how to start converting from a taxable environment into a non-taxable environment. Factors to consider: one is the length of your retirement, two is the current standard deduction, three, the tax bracket capacity, and four, projected growth in the IRAs. Strategy three, it's called tax harvesting. It's an interesting concept because with tax harvesting, you're going to sell securities at a loss to offset the capital gain from another investment that you had. So, and it also is typically employed to limit the recognition of short-term capital gains as well. Remember, short-term capital gains and anything that happens within a 12-month period becomes or gets taxed as ordinary income. The benefit to generate tax savings in places that can often be overlooked. Strategy number 4 is distribution planning. Distribution planning comes down to what type of accounts you have, how much money you need to pull from those accounts. The Secure Act, it changed a few things when it comes to required minimum distribution. One of the main things it did is it pushed the starting age for a required minimum distribution from 70.5 to 72. Now, when it comes to distribution of qualified plans, and I'm talking about 401ks, 403bs, 457, TSPs, the IRS is very, very clear on what you can commingle and when you have to take it separately. So the IRS says that if you have money in a 401k, 403b, 457, a TSP, you must take the RMD from each and every one of those accounts separately. So you've got $100,000 in a 401k, $100,000 in a 403b. You have to take the RMD from the 401k, and you have to take the RMD from the 403b. You cannot commingle. Now, if you do, it will cause a 50% penalty. That is why it is critical that we must understand this. And this is, one of the reasons why I'm so adamant about moving some of the assets out of a company retirement plan into your own IRA. If you have everything under an IRA, the government doesn't care, where you take the money from. In-service distributions. You may have or may not have heard of this. It's becoming more popular now. Sometimes the rules for a lot of places that if you're under 59 and a half, or you're separated or anything like that, that you can't touch your retirement plan. That's not true. Many companies today will allow you to do what's called an in-service distribution. It means that prior to leaving your job, or prior to age 59 and a half, or immediately after 59 and a half, you are able to go into your 401k, your 403b, your TSP, and move those over to your own IRA. This is one of the ways for you to take control of your money. And when you do that, you have a lot more options as well with an IRA. So that's certainly something to take a look at. Net unrealized appreciation. This is probably something that you may not have know about or has gone unnoticed. Let's say you work for Ford, and in your 401k you have purchased Ford stock, and you have a lot of it. Now the IRS offers a provision that allows for a favorable capital gain tax rate on that stock. So basically what the net unrealized appreciation is a difference between the original cost basis and the current value of the shares. Three rules with this. One, it must be transferred in kind. Two, under the rules, you can elect to defer taxes on the NUA until the time that you liquidate the stock. The remainder of the account must be rolled over into an IRA after a qualifying event. Once again, please speak with your tax advisor, CPA, regular advisor, to determine whether this is something that will be of benefit to you. we're going to throw some extras in here. If you're married filing jointly, the standard deduction is going to be $25,000. Now, if you're over age 65 and married, you're going to get an additional $1,350. If you're not married, then the additional is $1,700. It always takes a lot to take advantage of an itemized deduction. But one of the things that you can do is you can bundle these deductions so you can start itemizing again. These are things that you want to talk with your advisors about as well to make sure that this is something that will benefit you. And I would encourage you to start planning for 2022 right now. SALT, which is state of local tax, that has increased from 10,000 to 80,000 in 2022. Any non-cash donations over 5,000 must be appraised, and it must be appraised by an independent appraiser. Build Back Better Act, Biden's tax law. Now, there had been some talk about that the capital gains tax rate would be raised. It will not. It will remain at 20%. The same thing goes with the top tax bracket. There's been some talk that it would move up to 39%, but it did not. It will stay at 37%. One change that it did cause is Roth conversions in excess of $650,000 will not be available. But this will not go into effect until 2031. So you've got about 10 years to make sure that you get your act together and move all of this taxable stuff into a tax-free environment. Again, this is why you should really, you need to learn about these Roth conversions. It is super, super important. Small businesses, if your small business is an S Corp, the net income will be subject to the 3.8% net investment tax. In years past, Congress had come up and waived this. I don't know if, going forward, if that will be the case or not. But anyway, if you're a small business and you're an S Corp, you may be subject to a 3.8% net investment tax. I know that I've given you a lot of information today in a very short period of time, so feel free to schedule a time to talk with us. Here's some additional contact information. You've got my calendar link. You see my email address there, as well as my company website. Feel free to reach out to us. We'll be glad to discuss any of these strategies with you. Thank you.